So the head of
Larry Fink, huh?
Larry
This is
Fink, head of
interesting.
BlackRock, comes out in an interview on Bloomberg and says, "Buy equities, buy stocks, 100%,
100%. That was a direct quote. 100% in equities.
Right, which is unbelievable. First of all, I mean, I don't think anyone should be recommending to anyone to be 100% in anything, in any sort of environment, right? I mean, that's just putting your eggs all in one basket. I mean,
Right,
that's
which
just,
is, I mean, diversification it's like a mantra among money managers, right? Diversification, This is not. This is the exact opposite of diversification.
Yeah. And I think that what his argument is that, you know, if you look at dividend yields, what dividends are paying as opposed to, you know, bond yields, you know, that's going to be a greater return. You have, you know, the Fed, you have easy money kind of pumping through the economy right now. And so, you know, add all these factors together, the economy is improving. You know, it's a good time to be in equities. You know, the contrarian, as you mentioned before, you know, would say all these people are getting so bullish right now, that has to be the sign of a top, right?
Well, and, you know, not only is it, you know, everybody should be 100%, it also defies all the conventional wisdom that says, okay, look at your age bracket, your retirement expectations, and you should adjust your asset allocation to reflect some of those characteristics. Now, someone your age might be a good candidate to be 100%.
Right.
Somebody my age is probably a little less so, probably needs a little bit more.
You know, what struck me as interesting was that when I first saw it, I thought, wow, that's a sign of a top, no doubt about it.
Sure.
Once people say things like that. But when you read the interview and you hear his logic, you have to consider what the Fed is doing.
Right.
The Fed, and this, I tell you what, Ben Bernanke, he won't admit it, but this was music to his ears. It was. They've been trying to get people to go into stocks. They've been tamping down yields on treasuries. They've been holding them down. They got their foot on the neck of the treasury market. They will not let yields rise. They are trying to force people out on the risk curve. And it's working.
Yeah.
I mean, that's part of it. You can't. So when Fink said that, when he said, look, the Fed's going to keep rates low till 2014, savers are getting killed if you're in treasuries. And, you know, if the world's not going to go into financial Armageddon, you're just going to get killed in treasuries. So that, you know, that's part of his logic. That I can kind of see.
And you've also seen this year one of the remarkable.
Not that I'm doing it, by the way, but I can kind of see his point.
Yeah, you don't have to put your money where your mouth is.
No, of course not.
But one of the remarkable characteristics of this market that contrasts so much with 2011 is in 2011 we had high correlation between asset classes, equities, treasuries, commodities, precious metals.
Really historically high. Everything was trading in one line.
It was moving in the same direction. This year, not the case. We've got equities moving in a slightly different direction than the rest of the asset classes, which says, effectively, to your point, that that Ben Bernanke is finally, after all these efforts, seeing some fruit for his labors.
Couple caveats to Larry Fink's remarks. BlackRock has come out since then and said, you know, these are his personal opinions. This is not what the firm believes. But, you know,
well, because they push products that are not 100% stock.
Of course, exactly. But to your point, Bob, I mean, all the stars are aligning for this market to go higher. It seems like every single data point out there, it seems like all the reasoning is bullish right now. And when all that happens, when everyone thinks the same way, that has to be worrisome.
Thank you, Mr. Stephen Russolillo. Right. And that's what you said before. You kind of coughed.
It may play out that way. It may absolutely play out that way. And it looks like that it could. But that's what the bears are saying. Wait a minute. Everyone's thinking the same way.
What? The old saying is they don't ring a bell at the top. But if you listen carefully, you can hear it.
But at the same time, overbought markets can stay overbought for quite some time. We could see this rally continue on fumes through the end of the second quarter into the third quarter.
Well, until the Fed starts raising rates, which is maybe 2014.